Trade financing, where financial institutions provide credit facilities in order to guarantee exchange of goods, is a centuries-old industry that hasn't seen much change with the growth of global trade flows. In 2015 alone, the trade finance market was measured at more than $10 trillion. Existing models are complex, inefficient, and costly, requiring multiple parties and significant levels of manual processing. Banks have high operating costs and risks of fraud losses, while buyers-sellers face a plethora of paperwork and delays, resulting in a poor customer experience. Multiple pain points exist, most notably, onerous manual review of financial agreements, dependence on intermediary correspondent banks for payment, shipment delays due to numerous communication points and paperwork, high probability for fraud with disparate systems. Deloitte has reimagined how trade finance can operate, leveraging a blockchain-based infrastructure to drive efficiencies, reduce cost base, and open up new revenue opportunities, like newer models of credit and funding guarantees backing the trade. Let's imagine that a buyer in Vancouver, Canada wants to buy 100 automotive tires from a seller in Hong Kong, China. We represent the obligation of the buyer to pay the seller for the goods, tires in this example, upon receipt of the goods as a blockchain-powered smart contract that underpins the flow. As a first step, the purchase order is created by the buyer and a corresponding smart contract is created on the blockchain to codify the obligation. Having the complete details of the order on the blockchain allows financiers, institutions like today's banks who provides credit facility to the buyer or a financial guarantee to the seller to review the terms of the purchase order in real time. Once the financier provides guarantee of payment, which is captured on the blockchain, the seller proceeds to prepare for shipment of the goods. Using the provided assurance, the seller would ship the goods and link the invoice to the transaction on the blockchain. Similarly, in the supply chain, the shipping company would be able to provide shipment tracking details, including bill of lading, and the import-export custom agents in respective countries would be able to provide clearance details that are written to the blockchain. Finally, when goods are received by the buyer and inspected, blockchain will enable capture of acknowledgement and receipt. The payment to the seller will then be triggered based on rules and conditions coded in the smart contract. If buyer is unable to make a payment upon receiving the goods, payment default rules will automatically ensure payment to the seller based on assurance provided by the financier. In this case, the funds would be settled from financier to the seller. In this future vision, blockchain enables us to question current orthodoxies. Instruments such as letters of credit are replaced by smart contracts that allow data to be reviewed and actioned upon in real time. Banks are able to reduce manual processes, potential for fraud, and counterparty risks. Financial obligations are enforced through codification of business rules and cryptographic and immutable algorithms. New infrastructures built on this technology also have the potential to allow banks to change existing practice of factoring and invoice financing. Documents such as invoices can become tradable assets that banks can repackage, resell, and securitize, enabling the creation of new markets and revenue opportunities. When the seller invoices the buyer, banks can obtain immediate line of sight into payment obligations and provide instantaneous short-term financing, resulting in improved economics of capital allocation. In example, the seller can benefit from such capabilities by enabling on-demand invoice financing solicitation from multiple banks, regardless of whether they are an existing customer of that bank or not. The seller can receive funds in real time with minimal touch points and manual paperwork. In summary, blockchain proposes deep foundational re-architecture, redrawing processes, and transforming existing business models. We believe that while the technology can be used to realize cost efficiencies in existing business models, the opportunities for realizing second-order benefits through new products and services are boundless.